Good morning and welcome to the Hardcore Mortgage Show brought to you by Capital Mortgage Funding. I am Becky Alley. I'm going to be on the ones and twos today, filling in for our boy Harvey. We got Harry on the Zoom, but let me bring it into my brothers from other mothers that are live with me right now. I got Mr. John Cole, but fellow top 1%.
What's up, guys? Happy to be back in the studio.
Oh, yeah, that's right. It is your first time back.
It's like I'm a little virgin again.
Oh, yay.
Oh, boy.
All right, what's up over there, Harry?
Hi, everybody. Good morning, and looking forward to having a great show. John, I'm glad you're in the studio, Becky, and introduce our special guest.
Okay, yes. So my guest, or our guest, I should say, to my right, he is very special to me. He's a personal friend. Literally, there's nothing that we can't talk about. He's a co-host of his own podcast, Building Walls, and I know he has a special announcement, so I'll let him do that. So, Mr. Chris Dayton, what is up?
Good morning, everybody. I am super fired up to be here. Thanks for having me. And
I don't think his mic's on right now.
I don't think his mic's on.
is this one? Okay.
All right, now we
Now
hear
we can
him.
hear you.
All
He's a
right,
fir-
let
he's
me-
a
let me
first
redo
timer.
it. Mr.
Wow.
Jackson Heights own.
That boy, good. Yeah.
Good and terrible.
Well, welcome. I'm so fired up to be here. Thanks for having me. And yes, very exciting announcement that I have merged my team, formerly known as the Dayton Group, to Mitten Made Properties. With a couple guys, Brandon Gentili, Aaron Bador, and us are all together now. We brought all our agents together. We service all of Southeast Michigan, and it's super exciting, super fired up to be here.
Yay, snaps for you. I love it when people are making moves in real estate, which we're going to talk about real estate all hour long. We're going to take all your calls, 248-539-9797. And before we get into all that, as I was driving here, because it's already the 20th of November, I was like, oh my God, it's less than a week and I'm going to be busting out my fat pants for Turkey Day.
So good. This is my favorite holiday. You get to eat on Thursday, rest on Friday, Saturday, Sunday, and then get back to it. And Harry loves this time of year. It's the Harry speech that's about to come out. You know, don't take the next 6 weeks off, blah, blah, blah. He's stale. He does the same routine every year.
Oh, Harry, you going to take that?
It seemed to have worked for over 32 years, but I think the point that John is making is at this time of year, everybody's going to celebrate. Everybody's going to be with their family, and that's great. And again, it is my favorite time of year, my favorite holiday. But, there's business to be done between Thanksgiving and New Year's, right? So people tend to take 6-7 weeks off and say, hey, we don't need to do anything. Well, Chris Dayton, in our industry, are you taking off 7 weeks?
No way. This is the hammer down time.
Yep.
You gotta celebrate. You can walk and chew gum. We can have a good time. This is the best time of year. We go out, we network. I mean, if you're gonna go out and party and celebrate and enjoy the holidays, it's not that hard to bring up real estate because, quite frankly, everybody wants to talk about it all the time.
No, you're right. And the thing is that why would someone want to work with a stranger? Right. So it's all about working with us and, taking the time to do those things. Right. So speaking about time, I want to talk about Michigan. What's going on? We're going to get into the rates. We're going to maybe talk about some inflation, maybe dip into the crypto if conversation goes Chris's way. But for the people that are trying to or in currently the purchase market right now, Chris, is it too late? Did they miss the boat? What's going on?
It is not too late. In fact, it's too late is really subjective. Because it really depends on what your personal situation is and what you're trying to accomplish. But that is cured easily with information. So that's why you want to call and talk to people like us to kind of figure out, okay, where am I at? Can I do what I'm wanting to do right now before? And we can give people some relatively good information about what is coming down the pipe. We do expect, interest rates can't possibly stay low forever. So there is going to become a time where it costs more to do what they're proposing to do, right?
You're right. No, I agree with that. And so as far as like the real estate, right, we're still talking about it's still the most competitive market we've seen. But when we're talking about the holidays, I like to call it holiday-itis. I personally have not seen where you're seeing that typical seasonal lull like we have in the past.
Right. With COVID the way it was, we didn't have any slowdown time because everybody was still able to work from home, do everything from home. So they wanted to expand, get into another home, get more room for their family, and you just never saw that lull that we usually have. Back in the day, like I'm 90, like I'm Harry, like I'm Harry's
my
age.
day.
I used to carry ice up hills both ways. But no, you would have a lull from basically right before Thanksgiving till after New Year's, and that was your little shutdown time that you get everything done. And I like having consistent business and keeping it going, because it gets you in that groove. It keeps you excited. You don't have to start over each year, and I really like seeing families moving in and trying to get in before the holidays and enjoying what they're going to do with the house and how they're going to decorate it and all the exciting stories that they get to share with us. And that's the kind of stuff that makes you just feel good about doing our job and keep you going.
Yeah, I mean, I definitely agree with that. And I feel like what I've seen in my desk, so like the last 6-7 months, it was really competitive. And I feel that recently it's still competitive, but I want to get your take on it. I'm not seeing these offers coming across my desk where they're $20,000, $30,000 over asking like we saw probably 6-7 months ago.
Well, I brought some stats for you.
Yeah, I like stats.
The supply of houses on the market right now is 1.6 months, and that is trending down. So it was going up, and then it just bent down last month, so it's coming back down, meaning that there's less inventory, so not as many listings coming onto the market. And that's per the MLS here, local here in Southeast Michigan. Days on market, 12. The average is 12.
So there's less inventory, but houses are chilling longer.
And well, that's trending up by like 2 days.
Right.
Like that means that if I list your house, it's sold in 12 days.
Okay. Oh my God, my house has been on the market for 5 days and I don't have an offer.
I know. So people trip out like, oh my God, it didn't sell in one weekend.
Right.
Yeah, it might take 2 weekends now. It'll be okay. Interesting. The sales price in January, the average sales price back in January was $192,000. That peaked in July at $237,000. And now in last month, in October, it was 225. So it's coming back down and it's balancing out. But you're still up well over 10% for the year.
And this is why they're increasing the loan limit. Come January 1st. We don't know exactly what it's going to be, but we know internally that we've increased our jumbo loan limit to 625 right now. Right. Actually, a couple weeks ago, right? Mm-hmm. So we can do $625,000 mortgages at the same rate, same procedures, same underwrite as the 548, 250 that other companies are limited to. And that is because we are looking forward and knowing that what we're going to have. And let's just hope that this keeps going on, and because that's just going to mean that there's other houses that become available on the market for people that normally wouldn't be able to purchase with a jumbo loan.
Yeah, you're absolutely right. And what Chris is basically saying, right, is that it's going up, right? There's no really trend of the housing market right now going in the reverse direction, which is why the conventional loan limit has been increased to 625, which means the FHA loan limit is also going to be increased. That's always right behind it, right? I believe that we're actually
65% of the conventional limit will be the FHA loan limit. I don't believe we've done that yet internally.
I think we might have, because I priced one out and it let me do it. So
the surprises this morning.
I know. So what that basically
Breaking
means,
news.
So what that means to our listeners, right, is that things are progressive here at Capital Mortgage Funding, right? We are not waiting until the first of the year to do these things. We're actually already taking the measures to get people into these mortgages that are going to allow you better underwriting, faster underwriting. It's going to put you in that position where you're not going to be in, let's just say, a jumbo financing, which is going to be stricter underwriting guidelines, right? The rates are a little bit different. It's a little bit, you're not going to have an option of having an appraisal waiver, right? So Fannie Mae and Freddie Mac have done things to make it easier to get into these homes,
Correct.
Right? So when we come back, we're going to talk about that. I want to get into inflation, a little bit of rates going on. So keep it right here, 248-539-9797. We will be right back. Welcome back. You are listening to the Hardcore Mortgage Show, brought to you by Capital Mortgage Funding. Capital Mortgage Funding is powered by Fairway Independent Mortgage, an equal housing lender, MLS number 2289. So before the break, we were talking about the housing market. We were talking about the conventional loan limit increasing, all the things, right? So before we get into my topic on how you can make inflation your frenemy, okay, I do want to get a little bit more on this purchase price part of it, right? So are you seeing where buyers are becoming a little bit more savvy as far as when they're making these offers? So the reason why I'm bringing it up is because we were talking about how we're not seeing as many of those over asking prices, right? And the stats are showing there's not a lot of inventory. So do you think it's going to start trending where you're going to start seeing people freaking out with their hair on fire, where they're going to feel like they need to negotiate? They just go in guns a-blazing again?
Yep. I think that's going to happen next spring.
Okay.
I personally do think that's going to happen. It's not happening right now, but you're still seeing offers. And it all depends on the quality of the home, right? If the house needs a ton of work, I think the days of sellers being able to roll up and being like, hey, as is, pal, this is how you get it.
Right.
You just take it the way you like it, and you're good. This is it. I want all my money, and I want it right now. And I don't think the sellers are quite in that position anymore. They need to actually make the home presentable. They might have to do a couple repairs. They can't just, roll out their junk house and get top dollar.
You can't, because you can't get anyone to fix it up right now. So
Yeah.
you want someone to buy this house that's going to do all the repairs for you, but who are you going to get out there to do anything right now? You can't get anybody on the books. I had a generator installed. It took 6 months to get the generator in. Then it shows up without the chip, the wireless chip.
Oh, yeah,
So
chippies.
the whole chip problem that they got. And Harry, that's not sun chips we're talking about. And
Barbecue chips, John.
barbecue, my bad. So yeah, it's just, so you got these houses that need all this work, and unless you're your own handyman, getting somebody out there to fix them up is going to be problematic. And you're right, they're going to have to be more presentable.
Well, and because they limit, if they're not in good shape or they have some serious problems, then you limit the type of financing that you can get. And if you start doing that, now you're cutting out big portions of your buyer pool. Right. And then when you do that, this seems pretty intuitive, but if you have less buyers, less demand for your home than normal, that is going to equate to a lower price.
Yeah.
Right.
Yeah,
So
but Chris, I think you started to make a good point. I think that we know that there are a plethora of buyers out there right now. I mean, if there was inventory right now, you could sell a ton of houses, correct?
That's right.
So what's going to happen going forward, we were on a national call with a national economist from the Mortgage Bankers Association last week. The projections for home sales for 2022, 23, 24, because of the millennials and the age group that are in, there's not going to be a shortage of buyers. There's going to continue to be a shortage of inventory to meet the demand of those buyers. Much like Becky was going to get into inflation and supply and demand right now, there's no shortage of money out there right now. And I believe right now, we're consumers, we're Americans. We want all that we can get. That's what's driving the prices higher right now. And as soon as the supply chain goes ahead and loosens up, people are still going to buy, and the prices are going to come down. But there isn't going to be a shortage of buyers out there in the foreseeable future in the home buying market.
Well, it's like, because you brought up millennials, right? I do agree with you. I mean, I saw some stats where they're talking about where the boomers, right? They used to be the biggest, they're out here doing their thing. And now the millennials, which I guess I'm a part of them. I'm on the older cusp of the millennials, but it seems that they're all coming into the buyer's market like right now. And I feel like that first time home buyer isn't your 24, 25. They've stayed at home a little bit longer. They went to college, and now they're coming out, careers, and a little bit more 33, around that age where your first time home buyer isn't exactly that 5-year house. They're looking for that forever home.
So Becky, what you said is exactly 100% true. The peak age right now for buying a home is 33 years old. So if you go back 4 or 5 years or fast forward 5 years, you're looking at anybody that's age of 28 all the way through 38 that's looking to buy a home. And as you pointed out, that is the majority of that millennial population going on right now. And that's why, for the foreseeable future, the home purchase market is going to remain very, very strong.
Yeah, I don't disagree with that. As far as anyone that's looking for financing, right? I want to put it out there, and I know John can attest to this, that speculation that you need 20% down, you don't need it, right? And sometimes it starts where you don't even know what your credit score is, right? And a lot of people think that these free credit reporting apps, that their scores are, well, I have a 740 on whatever they're using.
Can't mention it. You might get yelled at because they might be a sponsor. But yeah, you're right. You know, these credit reporting companies that you see on TV, they are only taking a snapshot in current time. That is not how you buy a car. You know, you buy a car with a historical credit report. You buy a home with a historical credit report, 7 to 10 year history. And you need to make sure that you're getting all the information from that or your lender so that you know if there's anything you need to fix up. And we just talked about, you know, these current situations that are popping up for our clients right now. And that's, you know, these are relevant things that people need to really worry about, because if you're not going to fix your credit up, then we're not going to be able to do the best situation for you.
Yeah, I mean, the days of I'm going to roll up on a house, like it, and then I'm going to tell you to pull my credit, it's done. Because those offers without a bona fide pre-approval are not even being entertained still.
Yeah, you should get used to not being jealous of your new neighbor who's going to be living there because they were pre-approved and they bought the house and not you. So.
Right.
So it's important that you surround yourself with a team. And we actually have a caller. I'm going to go out to Jerry. He's looking to sell his house. And it looks like you're talking about maybe updating. So I want Chris to take this because we'll go ahead with your question.
Okay, my question is, I was considering putting it up earlier this year, but it was just not possible. So I'm hearing that the spring might be hot again, and if I put it up for sale then, it needs updating. I mean, the basement is like a tavern from the 80s.
That could be cool.
Yeah.
Vintage.
Yeah. The bathroom, except for a walk-in tub and new toilet, needs updating. It's only a 1.5 bathhouse with 3 bedrooms. But the kitchen, I don't know when it was last touched. I'm assuming the late 80s, 90s.
Well, how about the roof? What condition is the roof in?
The outside
and some
is
of the
where
other...
the money went.
What's that?
The outside is where $55,000 went.
Okay. So the outside is updated.
So that's good. So, you know, a lot of the main core things, if you only have cosmetic things to do, that's good. If it's deferred maintenance, that can be a challenge with selling the property. But I wouldn't necessarily wait. It depends on what you're trying to accomplish. If you need to take that money, there's opportunities with seller equity that you can redirect those proceeds into better investments and things like that if you're going to get rid of the property, because the net gain that you're going to get from maybe waiting is speculative. You might get more, you might not get less. I say that I think that the spring market is going to be good, but I certainly did not
You didn't bring your crystal ball?
I don't have my crystal ball.
No.
Oh, Miss
And I
Cleo.
forgot my magic tricks and all those other things in my foresight. But, you know, reasonably expected, you know, if somebody's looking to sell, I think the bigger thing, and we're going to get into this with the economics part of it and inflation, is being able to lock in on using money and getting certain rates of return and protecting yourself and hedging. So if you can sell and you have equity, you probably should do it sooner rather than later.
Jerry, let me ask you a quick question. Do you live in the home?
Oh, yeah.
Okay.
My mom lives with me.
Okay.
She's disabled. That makes it difficult to do all this.
Right, and then getting the work done while she's
still
still in the house is going to be a little bit challenging and inconvenient for you. So this is what you need to do. We, excuse me, we talk about this all the time. You got to get with your team, right? You got to call Chris Dayton and you got to have him come out and take a look at the house. He will give you honest advice on whether or not he thinks it's worthwhile to inject money into it to fix it up. Because if you're not going to if you're going to inject $30,000 to update this home and you're going to get $30,000 out of it for the sale of it, why are you going to go through the hassle of doing it? Let the next person do it.
Right.
So you really just need to get with your professional, let him give you good advice so that you can make an educated decision. And that's the best way to move forward. If Chris comes out there and says, you can put 10 grand into this and I can sell this house for $50,000 more, then you'd be foolish not to. But, you know, you need to, that's, you know, talking about this over the phone is never going to get us anywhere because we don't know. And,
Right.
you know, Becky and I never Becky, Harry, and I never see the homes in person like your professional real estate agent does. And they're the ones that are going to get out there, see what's selling around your area, what kind of shape the house is in, deferred maintenance versus cosmetic, and you need to get with that professional so that they can give you the best advice. And I know that we'll get Chris your number off the air so that he can reach out to you and see if it's anything that you can do. And here, you just can't go wrong making another phone call.
No, that was a great call, Jerry. We appreciate you giving us reaching out, and we will definitely get you in contact with Chris after the show. I mean, because in reality, it is situational, right? Every home is going to be different. Whether paint is going to do it, or if maybe people want that old school '80s tavern, right? It's really just all going to be situational based off what's going on.
Okay, I appreciate it.
All right, thank you so much. Okay, so that is right. So you're talking about. You got someone that's trying to sell their house, thinking about selling their house, and every right to say that where it is situational. Like, is it going to just be paint? Do you need to get rid of the '80s tavern? Maybe they want the deer horns on the wall. Who knows, right? Wood paneling might be coming back. I don't know, but you better be coming back after this break. We're going to take all your calls, 248-539-9797. We'll be sitting right here. Welcome back. You are listening to the Hardcore Mortgage Show, brought to you by Capital Mortgage Funding. I am Becky Alley. I'm joined by my other brother, John Kolb.
What's up, guys?
Mr. Chris Dayton.
What's up?
We got Mr. Harry Glanz on the line. We're going to be taking all your calls. We are pumped up to be here. The number to call is 248-539-9797. We obviously want to hear from you. What has your housing market been like for you? If you're in the market, did you just buy? And what is your, did you feel frustrated? Did you get out for a little bit? Did you want to, jump back in again? So those are things that we want to hear about. Before we get into our inflation talk, because obviously that's like a thing right now, we do want to go to our caller, Nat. What is going on?
Hey, how are you guys?
Or is
Good.
this Nate? Nate, I would assume. I'm looking at Nat. What is your name?
Nate.
Nate, okay. All right. Sorry about that. What's up, Nate?
I'm just calling because I recently bought a house, private sale, way under market value, with a great interest rate of, I think, 214 or 230, 34. So obviously I don't want to refinance. But the issue that I'm running into is when I got the house appraised for my mortgage, they just took the sale price, which was, 75 or, 150 under market. It's in Bloomfield Hills. So I got it for 380. The houses around me, were worth 450, 520. And I'm wondering what I do. I don't want to refinance, but I want to drop my PMI. And we've also expanded the house, 350 feet and, renovated it, new kitchen, basically gutted it all. So I want to know, what do I do to get rid of the PMI, and also so I have a little bit more cash in my pocket? I know there's various ways, but I'm not sure what the best method would be.
Okay, so the only method is going to be a refinance. Or actually, well, I'll let John. But my thought would be, if you're trying to get rid of the PMI, if you can either, you could probably do a recast depending on where you're at right now if you have that equity. But if you're trying to pull the equity out of the home, then you're going to have to do a refinance in that situation. Is that kind of what you're asking?
Yeah. I mean, obviously, I wouldn't. The interest doesn't bother me too much, just for the PMI, just because my interest rate is so low. To refinance, I don't think I'd get anything close to the 214, to what I have right now. But it's really, what are the alternative methods to get cash in my pocket? Because I just, spent a lot of money on that kitchen. So I thought, if they valued the home at 380, maybe I could ask the mortgage company to come back and reassess it, and they would be like, oh yeah, your house is now really worth 520.
All right.
Because it seemed like when they appraised it, they just flat out took the easy way out. Oh.
No. That's here. Those are guidelines. That's how we do mortgages. That's we're the lower of the two, the appraised value of the purchase price. So if you're going to go in there and undercut the market and get a good deal on a house, you're going to go off of that value with when we do our lending guidelines. And that's just the way it is. So you've got a couple different questions here. First and foremost, you want to take cash out of the house. The only way to take cash out of the house is to, like Becky was saying, is to do some sort of refinance. You don't necessarily have to do it on the first mortgage. You could take a home equity line of credit out and take that, but then you're at a higher rate. It could be a variable rate. Second mortgages, home equity line of credits, they have different underwriting guidelines. So you're probably going to have to wait a year for that house to be seasoned before they're going to let you use the appraised value versus the purchase price. Now, if you're talking about wanting to get rid of just PMI to get out of the home, that's something you could call up your current servicer and say, hey, I need to drop my PMI. They're going to have their own policies on what and when they're going to allow you to do that, and when they're going to allow you to use a new appraised value. Typically, if you're not going to do anything cash out, it's a 6-month waiting period. So when did you buy the home?
February.
Okay. So you're outside the 6 months, right? So you might be able to call up and say, I want to get a new appraisal on my home just to drop the PMI. That will keep your rate the same, keep you on the same amortization. It's not going to adjust your payment other than to drop the PMI off. But everything else will stay, copacetic. But if you're talking about getting cash out, then you're going to have to either refinance the first mortgage or do a second mortgage. Now, my big thing with second mortgages is this. How quickly are you going to pay that off? Because you got to analyze that. If you're going to take $70,000, $100,000 out on a 5% interest rate on a second mortgage, that doesn't make any sense to me. And it's going to take you 15 years to pay it off. Run the numbers on what the payment is with your interest rate is in the twos, whatever it may be, and compare it to a new 30-year or a new 20-year, whatever you want to get into, and what that rate will be. Because if you're in a second mortgage and it's variable, when these rates start going up, your second mortgage is going to go up higher and higher and higher. I have a second mortgage on my home right now. Fortunately, I don't owe anything on it, but the rate's 6%.
Yeah, the home equity lender, the home HELOCs, we'll call them, right? The interest rates are a lot higher than your standard mortgage. So that's a great call, and we're definitely going to reach out to you after the show because you're right. I mean, you don't know what you don't know, and it sounds like you have a multi-layered situation, and it's just about really having that conversation, us running some stats to figure out what you need to do to get you in the better position. So we'll definitely reach out to you, Nate. All right, thanks for the call. Okay, so that was obviously it's situational, right? He locked in a great rate. The rates are kind of trending upward. So for him, what we're going to get into right now is inflation, right? So, and that's kind of where we're going with does it make sense for him to, get into a little bit of a higher rate because everything has went up from milk to gas. You're talking about interest rates are going to be going up here sooner than later. If you're in a rental situation, right, those rates are going to be going up. So as a homeowner or a person entering the market, how can you make inflation your friend? Tell me, Chris.
Well, my recommendation would be to lock in. So anytime you can, think of it like this. Yeah, I'm going to get into a mortgage. Let's just say you get a mortgage for round numbers. It's $1,000, right? And it's going to be $1,000 a month for that principal and interest payment. Okay, so the only variable you're going to have in your home payment is the taxes in the municipality that you live in and the insurance on the home. But let's lock in that principal and interest payment. And $1,000 might seem like a lot to you now, but maybe it's $2,000 a month, whatever. Just in your head as you're driving around or listening to us, just think of hey, where am I comfortable or where am I actually stretched? But then imagine 7 years from now, as things continue to rise in price and cost, if your home mortgage, the single biggest bill of most people that they have in their monthly budget is their home. And if that stays the same and is a constant because you're in a locked fixed rate, then you are literally hedging against inflation. And there is a window on that. You're going to run out of time before those start to creep up, like John's talking about, like Becky's talking about, that if you don't get in, if you end up borrowing money, on a first or then opting into a second that has a variable rate, that's going to adjust upwards every year. It's going to cost more money to borrow money.
Right.
Yeah, and it's not going backwards. I mean, so the way for you to get hold of it is if you think about it like a 30-year fix, you are securing, like Chris was saying, the bulk of your money for almost for almost sometimes your lifetime, right? For the life of that loan, you know what that payment's going to be. And yes, taxes and insurance are going to fluctuate a little bit depending, but that's going to be guaranteeing that you have something that you can afford before these rates do start to go up, which it's going to be looking like mid of 2022. So we're going to get a little bit more into that. I feel like that was just a little bit of a teaser.
Yeah.
So hit us back, 248-539-9797. We want to hear from you, and we will be right here when you get back. Welcome back. You're listening to the Hardcore Mortgage Show. I am Becky Alley. The Hardcore Mortgage Show is brought to you by Fairway Independent Mortgage, MLS number 2289. We are an equal housing lender, so check us out online. Call us. We're here all the time, and we're here right now in the studio, and we want to hear from you. 248-539-9797. Okay, so right before the break, we were just touching on the inflation and how you can make it your friend versus your enemy, right? So we talked about you want to lock in your rate. That's number one. Number two, the people that are thinking about, do I want to buy? Should I wait? My opinion is the answer is no. If you're trying to beat inflation, because you got to understand, a $250,000 house that you bought last year is really going for around $300,000 this year, right? And they are projecting anywhere between 2 to 16% of a sales increase, depending on which site you're looking at and you know who you're talking to, right? But either way, there is definitely going to be an increase in what homes are going to cost this time next year.
Absolutely.
Yeah, it's a no-brainer. I mean, all the projections say the same thing. We see it in the day-to-day market. I'm not a big stats guy. I'm not a big read the news and see what they're telling you, because the news is always 2 weeks later than what's actually going on. But what we see every day, week to week, with our real estate partners, within our own company, is that prices are still going up, even over the holidays. And it's.
Well, and John, if the cost of goods keep going up, and then it costs more to build a house, so new construction is now increasing in value, because they go buy somebody and they buy a new house, and it's like, hey, this all costs A, B, C, D, E, F, G plus together, adds up to that. Yeah, right. Then, then the resale market feeds off of that.
Right.
But it's slow because there aren't enough builders, and then there's prices going up, more demand.
It's hard to get the supplies.
And so it's pretty intuitive to say prices are going to continue to rise.
Correct.
Yes. So the time is now, obviously. So it starts with a decision, right? I'm big on you're one decision away from changing your life, from meeting the right person, having a great business deal, Mr. Dayton. Congratulations on that, right? So you make that decision to buy, sell, refinance, and you're in the middle of this transaction. Okay, so I want to do a little buyer's advice here, right? So I know we have there's some crypto millionaires out there walking around, right? Thinking about buying their houses, buying this, buying that, right? But you're in the middle of a mortgage transaction. I will say that when Black Friday sales come around, even though you might be a crypto millionaire, do not open the debt. Do not open your credit debt, because even though it's tempting to buy those appliances before you own the house, you're going to create a little bit of a snag for yourself in the transaction, regardless of what your funds say in the Bitcoin.
Yeah, your Coinbase account. You open up and you're like, oh, wow, this is awesome. All these coins are going up. But, you got to be able to translate that to a real asset at some point.
Mm-hmm.
Right. And documenting that for our purposes is a little bit of a nightmare. I mean, it can be done. We can use cryptocurrency when you convert it to cash in a real bank, but we have to document it much different than you would normally. And just be prepared to get your last couple years worth of documents together so that we can track it the right way. It's still not a asset that is used by everybody.
Now, let me ask you this, because there is a development in New York City that came out just this past week that there are 3 condos. They're about 3,000 square feet apiece, and they're going for $29 million. But they will only accept Bitcoin as payment through some app, BitPay or something like that.
That sounds like that's someone's personal.
That's a cash transaction at that point. That's not.
So that seller, though, once they accept that, how do they translate that? Because they're giving up a real tangible asset. They're giving up a warranty deed, to somebody who gave them a virtual currency.
Right. But they could give up the warranty deed for $1 versus whatever. So or nothing. Not really nothing, because you have to have at least $1 into the stake. Am I right in that, Harry?
You are correct.
Yes.
There has to be some consideration given.
Right. So whether it's $1 or if it's 29 million in cryptocurrency, it can still be done. It's just that we can't do a mortgage. That's a cash transaction at that point.
Yeah. So what you're saying right now is because there really is no regulation with this cryptocurrency that, it seems like most people got into it, from what you're hearing, but it's viewed at almost like a stock. at this point.
Right. I mean, it's got a day-to-day trade. So
So how could it help you qualify for a mortgage, though? Because if I have a client who doesn't have a ton of cash in their liquid bank account, like their Bank of America account, but they've got a crypto, like a Coinbase account that's got, $72,000 in it.
Stupid in
something
it.
dumb. Like they're like, okay,
basically,
how do I go buy a house with this?
So basically what we've done in the past is we've had to document the money going into the crypto account, and then document the up and downs of it, and then also the withdrawal out of it. So instead of just using a 2-month or 3-month bank statement like we normally do for regular assets, this we had to show how the money was injected so that it was at one point cash that we could track. So it could have been a year, 2 years ago, but we have to show, and then we show every statement from there on out from the crypto account to show the up and downs in it, and then you show the pull out. So yes, you treat it just like a stock, but right now we're having to document it for a longer period of time since the inception of the purchase of the asset, and that's what makes it a little bit more difficult. So yes, we can document it because we know that $30,000 went into the crypto account over the last 2-year period. It has gone up and up and up, and now it's worth $75,000. So it's like Becky said, it's just like a stock. But we have to document it for a longer period of time. And because it's not a recognized asset by everybody yet, we have to document what was a recognized asset at the time of the inception of the account, and then watch the fluctuation from until the time of turning it back into a recognized asset.
Now, doesn't that sound sexy, everybody?
I mean, it sounds.
I tried to
inevitable.
use my sexy voice.
It definitely sounds
that was
inevitable,
great,
but
John.
not imminent. Yes.
Yeah, I mean, so the
Yeah.
thing is that there's a lot of regulation that hasn't came out yet, right, Harry? I mean, so it's a lot of, we're still in uncharted territories when it comes to document these kind of funds.
Yeah, it's all about tracking it, like John said. To consolidate that, condense that, is that you have to see it going in, and then we have to see it converted to cash, and then track it coming out.
So just do yourself a favor and just know that when it comes to buying more, getting a mortgage, cash is not king, right? Just like we were talking about, you do not want to open the debt and buy the appliances before you own them any more than you want to wait and hesitate and not lock in your rates right now, because they are going to be going up. It's no secret. Everything's going up right now, and it's just a matter of getting control what you can control.
Right. And regardless of what the debt that you're going to acquire when you open up or buy those appliances or the stereo system with the flat screen TV, the credit cards that these companies are giving you are causing your score to go down right away, because when you go out and you get an interest free credit card from whatever company it may be for that $5,000 appliance or stereo system, they're giving you a $5,000 limited credit card as well. So all of a sudden you've just opened up a credit card that's maxed out. And that's going to hit your credit. When you max out your credit cards, even if you're paying them off in full every single month or making the payments on time, you're still going to get a credit score ding because you've maxed a credit card out.
Yeah, I agree with that. It's actually all about timing. I just had a conversation with someone yesterday about their credit score, and they're like, "Oh, well, it was just a 720." Okay, well, I'm looking at your credit report, and I can see you recently made a larger purchase. It's all about timing, and we can fix that. So that's why you want to be with professionals. You want to talk to someone like Chris, John, myself, anyone at Capital Mortgage Funding, Harry, our fearless leader. It's about us being able to analyze the situation, because every day is different as far as depending on what day we pull your credit and what day we don't.
Yeah.
Can I just say something on that real quick? Just
Yeah.
that it matters who you work with in this business. And I know you probably hear that all the time. And if you're listening right now, you got to know that even on the mortgage side, it really matters who you work with. On the real estate side, there's a big difference. You can make a lot of money or lose a lot of money based on who you're working with. And you need to have an agent who knows what they're doing. I got a lot of good co-broke agents that I've done business with. A beer Horvath in Dearborn, I just did a deal with, actually Allen Park. Mm-hmm. And having the agent on the other side of it, knowing how to get to the end of the deal, working through problems matters. Representing their client matters.
Doing it the right way, working
doing
together.
It the right way.
Yes.
And like being able to communicate and have high level of communication is so vitally important in this business, because people are emotional. And when we're talking about this, and even with their crypto accounts, people are super emotional about that, or they're emotional about their cash in their hand and they want to buy a house, or maybe they've had it for a long time and they just they don't want to part with it.
I mean, you're talking about
Yep.
the biggest asset you have. I mean, and even with, let's just say your crypto, you got these brand new, some people are fortunate enough to, be millionaires now. And now that's money they've never had before. And you're right. Everything is emotional and communication is key. And when you have a team around you of professionals that, no, it's not you versus them. It's not the buyers versus the sellers. We are all trying to get to the end of the road.
Yeah,
and
it's not the Highlander.
Yeah.
There can be only one.
It is me. I am king. Oh, man. All right.
And we end on that.
Yes, the Highlander.
Highland.
Go State.
Oh, yeah, we got a lot
go
of big
green,
games.
buddy.
We got like Ohio
Go
State
green.
game today. Yeah, we like big stuff going on. So we want to wish you guys a happy Thanksgiving, right? So it's been a tough year for a lot of people, tough couple of years. So when you get to be around your family this year, we really here at Capital Mortgage Funding on behalf of, Chris Dayton, we hope your home is filled with laughter and everyone that you missed last year, whether they're there with you physically or in spirit. We want your home's laughter and every window filled with a possibility. So give us a call at Capital Mortgage Funding 7 days a week.
Peace be with you.